welcome to the OANDA Market Pulse Charting Analysis video. My name's Craig Erlam, Senior Market Analyst at OANDA. Now this video is going to be focused on indices. We've already recorded 2 videos today covering FX and commodities. Now unfortunately for those who have seen these videos already, I am going to repeat myself just a little bit because I do want to highlight for those who haven't seen the other videos that that this is an extremely busy week for the markets. It could be another extremely busy week for the markets. We've got some key economic events which I think people should be aware of when trading the markets this week. It doesn't mean you have to be a fundamental trader to pay attention to these. You can be an entirely technical trader, but then it's always worth being aware of these major economic events which could have an impact on your trades, which are going to be primarily driven around certain times by fundamental events. So events like this include the Fed decision on Wednesday evening. Now the Fed's not expected to raise interest rates further, but there is a statement to be released alongside it, and given the market turmoil that we've had so far this year, the decline in commodity prices, it may influence how hawkish the Fed is compared to how hawkish they were in December, and what the path of interest rates will therefore be, which will have an impact throughout the markets really. It will impact the dollar, it will impact bonds, it will impact equities. So really this is one of those events which I think is worth keeping an eye on and worth positioning yourselves around, whether or not you're a fundamental or technical trader. The same applies to the Bank of Japan on Friday morning. The difference here being that they may actually ease monetary policy further, and again that could have a major bearing on certain markets, particularly things like the Japanese yen if you're a yen trader, the Nikkei if you're an equity indice trader. It can have an impact, and it can also impact the broader markets from a sentiment perspective as well. We all saw what happened last week when the ECB gave a very dovish, when Mario Draghi of the ECB, was very dovish in his press conference, talked up the potential for further stimulus in March. This had an impact on the broader market, not just European equities and European the euro and the euro. So this does tend to have a broader market impact, these major central bank events in particular. But we've also got things like GDP from the US on Friday, GDP from the UK on Thursday, durable goods orders. The list goes on. There's a lot of key data being released alongside these central bank decisions, and regardless of what you're trading, I always think it's worthwhile being aware of them and positioning yourself accordingly. Now let's start with the German DAX today, and now what I wanted to highlight here in particular is the fact that we did have a nice bullish week last week. We rebounded off these lows, which I thought were extremely key. Now we didn't manage to have a sustainable break below them. What is interesting is we've already had a break below the long-term ascending trend line, which goes back to 2011 Eurozone debt crisis lows. Now what I was saying here was that is a strong signal that we are seeing going to potentially see a much more protracted move to the downside. Already the DAX is in bear market territory at this stage, having fallen more than 20% from its highs in the middle of last year. What was going to be interesting though is if we see a break of this key support region, which has been a very important region of support for just a little over a year now. Not only would that suggest we're going to see that we've already confirmed in bear market territory, but it may actually suggest that the moves to follow are even more bearish again, which could cause significant implications for the market. Now we had this support level hold up. What's more interesting though is that we are actually trading back above the ascending trend line. Now we are only trading marginally above, so if we see another move to the downside, I won't really be paying much attention to that. But the fact that we are trading back above, and if we see another move back towards these 10,100 to 10,150 levels, then that may suggest that the market is a bit more bullish than we were anticipating, or a little bit more bullish than the feeling you get when you're in the markets right now, given the fact that everyone seems to be extremely pessimistic. And this may suggest that this was just a false breakout. Of course, if we do see a move back towards this 10,100 to 10,150 level, and we see this rejected at the first time basking, which is also the 38.2% Fibonacci retracement level of the 3rd of December to 21st of January moves, then that may actually suggest that things are still quite bearish and we could see a lot more downside pressure to come. So I think again, while I was highlighting last week as being a potentially crucial week for equity markets, I don't think this is over by any stretch of the imagination, just because we've had a strong rally towards the end of the week last week and we've moved back above that ascending trend line. I think there's a couple of key levels to come now, one being the 1090 here, 1092 1150. Very key region of resistance at this stage, not only of course because of being price support and resistance, 38.2 fib, but again, if we see a break above here, then we've made higher highs and potentially higher lows, which would suggest that at least in the short term, things are looking a bit more bullish. So there's a lot that can be read from how the markets are going to be changing potentially in the next over the coming week or so. Next is the Dow 30. Now, we've highlighted again on previous videos that we've got this long-term ascending trend line which dates all the way back to 2009 lows. So this is the height of the financial crisis lows. Now, we had the third touch on it recently, but to coincide with the ascending trend line, we also had the 200-week simple moving average, which was providing some support, prior levels of support as well. What's interesting here is we did see these broken temporarily. We saw it pull back towards these prior lows, which the prior lows of 2014 and 2015. It failed at these levels, moved back above the ascending trend line and the 200-week simple moving average, and actually closed slightly higher on the week. While this does represent something of a potentially maybe an indecision candle or slightly bullish candle, I'm not necessarily bullish at this stage. I'm still very cautious with this, just because we have traded below. Maybe this was just maybe this is just a bit of a bear trap here, but for me, I'm just not too convinced by this at this stage. We are still trading around the 16,100 level, prior level of support. We're not necessarily seeing a big lift up to the upside at the start of the week. We're yet to break above these previous highs around 16,225. Also prior level of support. I still think there's a long way to go before the market starts to feel confident that we are going to see a move to the upside, and that we're not going to see bear market territory or strong signs of bear market territory in the Dow. But at least for now, it is looking a little bit more positive at this stage. I think 16,225 could be a key level of support here, and beyond here maybe around these 16,600 levels having been prior resistance. But for now, I like to say, I remain very cautious. This could very easily just be consolidation here, at which point that would suggest that we do have plenty more downside to come. So interesting times again for the Dow. Now, what is even more interesting about the S&P 500 is, again, we've got this ascending trend line which dates back to financial crisis lows. Now, it's not a perfect trend line because we did see the index trading below the ascending trend line at times in 2011, but the fact that the trend line continued to be respected following this suggests to me that this was just some choppy trading, and to be honest, I still think personally that trend line is legitimate. We've seen two occasions since that the trend line was respected, 2 occasions here when the trend line was respected again. Now, why that is important is because we've actually had a close below that ascending trend line. Now, this may just be offering an earlier signal than its other US counterpart, the Dow 30. We have pulled back towards these prior levels of support. We had a very nice technical bounce off these 1800 levels, which again was previous support, and we actually closed higher on the week. Now, like I say, this is positive because it suggests that this level is very well supported. Maybe the market's a little bit more bullish than we thought, but we are far from in the clear yet. We're yet to see it move back above the ascending trend line, and as of yet today, we're not really seeing that much upward momentum. This could just be a mild correction. We are trading probably above this what we had highlighted as prior support, potentially turn resistance. But really, what I want to see a move above at least is going to be these 1913 levels, having been the high from the 19th of January, but probably even moving back towards these 1950s and 2000. I think 2000 would be the very clear signal that this bear market territory, which people were fearing, is not necessarily going to materialise. This obviously highlights a potentially key region of resistance here between 1950 and 2000, but at least for now I need to see 1912 and maybe even 1950 broken, because at the moment I'm just not convinced yet that we're not headed for bear market territory here. That trend line has been broken and we're yet to move back above it, and while this is quite a bullish looking candle, nice long lower wick as we got on the last 2 occasions that we saw these levels threatened, we're not seeing the upside momentum that I'd like to see following it. So again, it is going to be quite an interesting week for these equity markets, quite an interesting test. For all we know at this stage, what the next move is going to be it a move back to the upside or a break of the support in both the S&P and the Dow, what may determine that could well be what the Fed does come Wednesday. If the Fed comes out with a more dovish message, puts off further rate hikes while the market settles down, then that may give this a little boost and move it back up towards these 2,000 and above. If the Fed suggests that the market turmoil at the start of the year hasn't influenced its decision, influenced the path of rate hikes that it alluded to at the previous meeting, being 4 potential rate hikes this year, then that could be the trigger for a move back towards bear market territory and move back below these 1,800 levels, which again would then bring around the 1625 to 1675. 1680 into play at the very least, I would assume, if we see this level broken, because I do think this is a very big support level. Of course, you may see support along the way around these 1730s being prior support and resistance, but I do think this a break of this would be extremely significant, and the Fed on Wednesday evening could determine whether we're going to see a break of these important support levels or a move back above the prior support and a potential calming for the markets. For more in-depth news and analysis, check out OANDA Market Pulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.